The information discussed in this presentation is current as of the date noted and is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality. And with that, I will turn things over to Todd and Scott to lead us today. And again, just a final reminder, please keep your mics muted, cameras off for the duration of the presentation, and please hold your questions until the end. Todd and Scott, take it away.
Well, first of all, I want to start off. In 2022, I read a study where Americans gave almost $500 billion to charities. That is a staggering figure. Americans tend to be giving people, and they do so for a number of different reasons. First of all, there's their personal values and their beliefs. People give to churches, to synagogues, to other religious organizations, or they really care about their local community. A lot of people donate through the United Way. People give to issues or items that they really care about. The Nature Conservancy is a charity that a number of people donate to because they care about the environment. People give because of some benefit that they or someone they know receives. If you've ever had somebody that has suffered from cancer, perhaps you've donated to the American Cancer Society because you want to help other people not have to deal with that dreaded disease. Or there's a particular college or university that has been a benefit to you. Maybe you're a graduate, maybe your kids or grandkids go there, and you want to help that educational institution along. So we give because we want to be a benefit to others. The tax advantage that is built into the IRS code is a benefit as we give, but it shouldn't be the primary reason we give. We want to give because we care about a particular cause.
I've got the second slide. Great job, Scott. Charitable contributions. I think the key here on the next two slides is really these entities, even though they are businesses, they really don't take the deduction. They're pass-through entities for someone working on their own or as a part of an LLC or in a small partnership. My wife is a perfect example of this. She has her own skincare business that she does on the side along with her W-2 income at the hospital. So she always asks me, what can my business write off? And the answer is, really, your business can't write any of this off. It flows through our personal joint tax return. So again, I think the key here is that the individual ends up taking the deduction, not the business entity itself. And that takes us to the next slide. What happens with this is when you do make a contribution, it goes on to the 1040, more specifically the Schedule A, which is your itemized deductions. Now, prior to 2018, we saw a lot more people itemizing their deductions using the Schedule A. In 2018, something came along called the TCJA, the Tax Cuts and Jobs Act. And what that did was it combined your deductions along with your personal exemptions, and the number is quite significant. So as an example, going back to my wife and my return, we're married filing jointly. Our standard deduction is over $29,000 this year. So not nearly as many people are itemizing deductions as they used to. So what I mean by that is your charitable contributions, along with some other items like home mortgage interest, like taxes you pay, like medical expenses that aren't reimbursed through insurance, All of those pieces of the puzzle have to add up to over $29,200 for you to itemize your deduction. So that's a quick summary on how the charitable contributions can fit onto your tax return.
So we want to determine the charitable vehicle. How are you going to give? And first of all, it's the size of the gift. There's a lot of gifts that you make that really don't have any tax advantage to them whatsoever. You know, the Girl Scouts or the Boy Scouts show up at your door and want to sell you cookies or something, and you buy something there. That's a good thing to do. There's no tax advantage to that. But perhaps you have hundreds or perhaps thousands of dollars that you will give over the course of the year. If you have receipts of those gifts and they add up enough, as Todd just mentioned, you may be able to itemize that deduction. And then there are some individuals that have the ability to give perhaps six-figure gifts or more. And there's some particular vehicles that work well for those. The account types, what are you giving? For most of us, that's just cash. But there's some creative ways to give. You can give a vehicle that you're no longer using. You can give a boat that is no longer being enjoyed by you. You can give household items to Goodwill, Salvation Army, the Habitat for Humanity Restore. You may have land that has value as far as conservation and recreation goes, and you may want to donate that to an organization. Perhaps you've been a collector of art or jewelry, antiques or stamps, and nobody in your family really wants those things. You've enjoyed them. They've been of great benefit to you, but there's nobody in the family that wants them. You can donate those to charities, and they can take the value for that. There are some very specific rules for what you donate, and you want to be careful that you talk to a tax advisor in making sure that you're doing everything properly. You can also donate highly appreciated stock. What I mean by that is you've bought stock for $10 a share and the company takes off. It's now worth $100 a share. If you just sell that stock, you've got a capital gains tax that you'll have to pay. We'll talk about that in another slide here in a little bit. But you can give that stock and get benefit of the whole contribution. If you have a traditional IRA, you can use what's called a qualified charitable distribution. And again, we'll have some details on that in a little bit. You always want to make sure that you get documentation for any gift that you make so that you can demonstrate to the IRS, if you're ever asked, that yes, indeed, you made a charitable contribution. And then who is the gift for? Again, we've talked about your church or religious organization, environmental concerns, but there are medical nonprofits that are doing research in various different diseases. There are fraternal organizations. The lodge that you belong to may qualify as a charity. There are veterans groups. There are the SPCA, Society for Prevention of Cruelty to Animals, is also a qualified charity. So as you think about your gift, first of all, you want to make sure that they are a qualified charitable organization. And secondly, you want to make sure that the money is actually going to the charity. Some years ago, I was the treasurer for our local volunteer fire department, and I was approached by a fundraising group that wanted to raise money for our fire department. So I asked them how much of the money they raised would actually go to the fire department. Well, 25%. They were going to keep 75% of what they raised for themselves. I said no thank you, and we did our own fundraising. And then the age of the giver. If you're a young person, you want to make sure that you've got enough set aside for your retirement. You don't want to give it all at this point. If you're toward the gray years of life, as I am, you want to make sure you've put enough aside for retirement for your giving. And then this kind of goes along with age, but we'll mention this, the idea of bunching gifts to take advantage of the itemized deduction. Let's say you're giving $10,000 a year to a particular charity. Well, if you take this year's gift and next year's gift and put it in 1 year, you can itemize that deduction, and you've now got a $20,000 gift. And then if you're over 70 and a half, you can use the qualified charitable distributions we talked about a moment ago, and we'll talk about again here. And then, is your gift simple or complex? A direct gift to charity typically is a simple gift, but we have some other ways to give that are more complex: a donor advised fund, a trust, or a private foundation.
I guess I'll start with the easiest and probably the simplest method of all, and that's cash. Very efficient, no fees or costs, and no administrative burden. So we're almost at the season where we see the wonderful volunteers out with the Salvation Army ringing their bell, and you put some cash in there. That is as easy as it gets. Like Scott said, if you do think you're going to do some more significant gifts rather than a handful of change or a few dollars out of your pocket, make a plan, benefit from it and save some tax dollars, bundle or lump some of those together like Scott mentioned, get over that standard deduction. The other thing I wanted to talk about, even though it's a cash slide, I wanted to also talk about non-cash gifts on this slide. Also the season where we gather up prior year winners of ugly sweater contests and throw them all in a garbage bag and go put them in the bin down the road. Be very careful with that. We need receipts now. There needs to be more of an accounting trail. The IRS is watching this, I think, a little more closely. There needs to be some tracking. So when you go to prepare your return or you have someone prepare it for you, make sure you know what was in that bag, when it was donated, who it was donated to. Make sure there's a bit of a paper trail there just in case the IRS ever asks questions. So we are of the season for some of those cash and also non-cash gifts.
So I mentioned a minute ago, long-term appreciated stock. You bought it low, it's now gone way up, and you can give that stock to an organization, a charitable organization. Now, we've got 3 different examples on the slide here. The first, we're donating the appreciated securities outright, and you'll notice a net tax savings of $4,700. You can donate the $10,000 in cash, and you get a tax savings of about $3,500, or you can sell the securities and donate the cash. The tax savings is down to $2,300. You're still giving the same $10,000 gift each time, but how you structure that gift benefits you tax-wise. And it also benefits the charity because as you give in a tax-efficient way, it gives you greater opportunities to give more. So the capital gains tax for most people is 15%. Some people it's going to be 20%. There's a few people that only pay 0% in capital gains tax. But by saving that tax, you are not only helping yourself with your tax return, but also the charity.
Donor advised funds, DAFs we call them. Interesting vehicle for sure to use. You get an immediate tax deduction for the entire amount. So again, if you were going to donate $10,000 over the next 5 years, you might want to think about doing a $40,000 or $50,000 donor advised fund. It's for larger gifts. As the title says, the donor has some say into when and where the grants go. quite flexible and pretty inexpensive. Usually the only fee is to manage the assets. So I know some of the larger custodians that we work with, Schwab, even some of the folks at like Fidelity can set these up quite inexpensively. And then the funds are managed, hopefully they grow, and then the charities benefit once the decision is made as to where these should go. And again, it's nice to have the flexibility where the donor makes the initial contribution, but then is still involved in the decision process of where those funds actually end up.
So, for private foundations, if you watch anything on public television, before you get to the program that you're watching, they're going to tell you who is sponsoring that program. And oftentimes, it is a private foundation. It is some family or some individual, could be contemporary, could have been years ago. They set up a foundation to make charitable donations. Some of the most famous of these, the Bill and Melinda Gates Foundation. They've done extensive work in Africa as far as health and nutrition, water. There is the Ford Foundation, Rockefeller Foundation. And these foundations are not soliciting for new donations. They've got money because either the individual or the business has made a considerable amount of money, and now they're giving back. So that's a private foundation. I actually know an individual who did very well in his own business and set up his own private foundation because he wanted his kids to be involved in giving after he and his wife had passed away.
That gets us to trusts, charitable trusts. So the abbreviations for these are CRUT, CRAT, CLUT, and CLAT. So really some about 2 or 3 pieces to this puzzle. They're all charitable and they're all trusts. And then it gets a little bit more complicated there. There's an income stream during life. So depending on where that goes, that's where you get the income that happens, whether that's going to the owner or to a charity. The second part of that is the remainder. Now something's happened, the owner may have passed away. Now the remainder goes to the charity, or does it go to a beneficiary, a child or a grandchild? The A or the U. The A stands for annuity. That's a set amount. So if each year the trust is going to kick out $5,000, that's a set amount. That's an annuity. The unit, the U, is a little bit different. That is a set percentage, which translates into the fact that it's not going to be a set amount. So if it's a 10% of the total that gets kicked out and distributed as income each year, that 10% amount is obviously going to move depending on what the balance of the account is, whether it grew in a strong year or stayed the same, or maybe went a little bit down in a year that the market corrected. So it sounds very, very complicated, but I think if you just break it down into the income stream, where that's going, whether it's the person or the charity, and then look at the remainder, wherever that ends up going, whether it's a person or a charity, and then you set an amount, whether it's a set dollar amount or a set percentage amount, it becomes pretty straightforward after that. Our soup, I like this slide. We often complicate things much too much, and it should be a lot simpler, but a lot of these abbreviations we deal with quite often. I guess because my first name is almost in there, I better start with TOD. That is just adding a beneficiary to a non-retirement account. So it stands for transfer on death. And the other one that I'll talk about as well is POD. Exact same thing, except payable on death. So what this means is that you're changing the titling of an asset. The TOD is for investment accounts. The POD is for bank accounts. So again, often very confusing, but when you dig into it, it really isn't. It's simply adding a beneficiary to a non-retirement account It avoids probate, and after one passes, it's very simple to distribute those assets.
So we'll back up just a moment there because there's some more letters we want to get to, Brian. The RMD, required minimum distribution. This is typically from a retirement account, and it's money you have to take out every year, depending on your age. The government has continued to raise the age for you to take money out, so it depends on your birthday. An IRA, an individual retirement account. This is something that you set up yourself, put money into, take some tax advantage from it, but eventually will either pay taxes on it right away if it's a Roth IRA, or pay taxes when you take the money out later in life. And then we want to talk about IRMA and Medicare Part B and Part D. IRMA is an income-related monthly adjustment amount. My apologies for people named IRMA, but we don't like IRMA. This is just extra money that people who have means have to pay to the government for their Medicare Part B and Part D premiums. One of the advantages of charitable giving is that it brings down your adjusted gross income. Thus, you have less that you're paying tax on because you've given some of it away. And so we can go on to the next slide now, Ryan. So let's talk a little bit about IRA beneficiaries. If you have a charity that you care about, you've got this IRA, you can name the charity as your beneficiary. It goes to them on your passing. It's very simple, effective, flexible, easy. It bypasses probate. There's a 5-year distribution for charities. In other words, charity has 5 years after your passing to take the money out. So you want to make sure that the charity is informed of your passing. So whoever you have as your executor, make sure that they're contacting the charity. The charity is going to fill out some paperwork to be able to claim the gift. But it's a wonderful way to give because you've got this account. You can just name the charity as your beneficiary. And then on this next slide, because of the Secure Act, there's lots of different technicalities with beneficiaries. What we really want to notice is the non-designated beneficiaries. This is non-persons, and charities is right at the top of the list there. Again, you can make a charity your beneficiary with your IRA.
Here's the follow-up from our alphabet soup. Again, just changing the titles on either an investment account or a bank account can really save a lot of headaches. Scott talked about beneficiaries on retirement accounts. These are beneficiaries on non-retirement accounts. Again, going to skip probate, which in a lot of states can be costly and can take a lot of time. So these designations really make a lot of sense. The TOD, again, is for your investment portfolio, stocks, bonds, mutual funds, ETFs, whatever you might have in there. The POD, the payable on death, is for your bank account, whether it's a single account, a checking, a savings, whatever the case may be there. Very valuable to add these titles and update these periodically, make sure nothing has changed in terms of the beneficiaries that you've named, but this really helps folks upon one's passing to really simplify the estate.
So we come to qualified charitable distributions. This is one of my most favored ways to give because it doesn't necessarily have to be someone who has a lot of money to give. You're putting money into your church offering plate every Sunday or every Saturday, whenever you're going. The combining of all of those yearly gifts into one gift and taking it out of your IRA is a qualified charitable distribution, and you get a tax benefit for doing that. And it's pretty simple. Remember, it's a required minimum distribution. You've got to take the money out anyway. So if you are putting money into some charity or your church on a regular basis, you can do it with a QCD and take advantage of it tax-wise. Now, there are some stipulations. It has to be a traditional IRA. You can't do this with a Roth. You can't do it with a SEP or other kinds of savings vehicles. Your 401k from work has to be a traditional IRA. And you have to be 70 and a half before you can start doing this. But it is one of the few ways that you can take money out of an IRA and not pay tax on it. So that's a great benefit there. It's going to lower your modified adjusted gross income, and it is very possible that it can lower your Medicare Part B premiums and your Part D premiums and your IRMA payment because, again, you've taken money out of your adjusted gross income. In 2024, you can give up to $105,000. And in 2025, that's going to rise to $108,000. So for some people, that's a significant reduction in your adjusted gross income that you have to pay tax on. So it can be very beneficial for you. A couple of points. Donation has to be made directly to the charity. You don't want the check to come to you and then you pass it on to the charity. You want it sent directly to the charity. And then there's also possibility of a charitable remainder trust or gift annuity. And this is a little bit more technical and complicated, so you'll want to talk to a tax advisor, but that is a possibility of taking money out of the IRA as a qualified charitable distribution.